Hi everyone, I'm Joel Carty from Solace Financial. Today I'm joined by Daniel Pennell from Plato Investment Management. Daniel is a senior portfolio manager and has more than 2 decades of experience in global equities, quantitative investing, and income-focused portfolio management. Before joining Plato in 2015, he held senior roles at Real Index, State Street Global Advisors, both in Sydney and in London. He's also chair of Plato's ESG committee and is widely recognised for his expertise in global equity investing, portfolio construction, and responsible investment strategies. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Dan, thanks for joining us today. Can you start by giving us an overview of the Plato Global Shares Income Fund and what makes it different from a traditional global shares fund?
Yeah, sure. Look, first off, Joel, great to be here and thanks very much for having us. Hopefully the next 20 minutes gives you a bit of insight into what we do. At the basic level, it's a dual objective strategy. So it's really important that we're focused on not just yield, but also outperforming. It's pretty simple in the way we create it. It's developed markets, B2 fully invested. And I think it's just a diversified, risk managed way for people to who are in retirement to kind of access global growth markets. When you're asking us what's different, I guess we're normally compared to either options funds or buy and hold yield funds. And the kind of key difference is we're no derivatives, fully invested, so we participate in the upsides. And then we generate income in a novel way I'll talk about in a moment. So compared to a buy and hold, we don't just hold high yield names, we're rotating through opportunities.
Okay, well, that then leads into the next question. How do you generate that reliable income stream from global shares while still maintaining some growth potential in the portfolio?
Yeah, it's a great question. I think we're sort of specialists in dual objective, and it's a bit different, whether it's low carbon and performance, high income and performance. We look at everything at the portfolio level. So the way we generate income is quite different. We rotate. We don't just hold high income sectors and stocks. So we don't just overweight, utilities, REITs and Europe and not have any tech. Because we rotate, that allows our stock selection process, which underpins every Plato fund, to kind of focus on that growth side as well as generating income. And so I think it's kind of a bit counterintuitive, but we hold growth names that pay little or no income, as long as at the portfolio level we're rotating to deliver the high income we've done over the last 10 years.
Okay, so what does Plato look for when selecting companies for the portfolio?
Well, in this strategy, it kind of feeds nicely to the objectives. We look for income, we look for forecast return, obviously. On the income side, we want kind of dependable income, looking at the next payments, and we also forecast the risk a company will cut. So we want to have good yields, but also to factor in any risks. And then on the kind of return side, I know you had Dave Allen on talking about PGA. We use the same model across all strategies, but a bit like buying anything, you want a quality product. You want it at a good price. You want a bit of sentiment, a bit of a trend for future value behind you, and no risks. And so if you look at it from a kind of company perspective, quality can be, earnings quality, management, balance sheet quality. But a lot of those good businesses can trade, as you know, at a real premium sort of nosebleed territory even. So we want to get it at a good value. We want to pay a decent price at a discount to intrinsic. As a lot of value managers will tell you, good companies that are cheap can stay cheap for a long time. So we want some kind of catalyst to unlock that value sentiment, a kind of trend behind the name. And then that fourth thing is just low risk. And so we've got a red flag model, I think Dave kind of talked about briefly, where we've systematized 150 risks. And that powerfully identifies companies that may underperform in the next 12 months. So yeah, looking for those same characteristics, but with this strategy, we don't short, and also we have that income focus. So we're also looking for some reliable income in there as well, Joe.
Perfect. So what are you currently seeing as the most attractive opportunities for global income investors at the moment?
We've just put out a Q2 update, sort of our most recent kind of what's happening in the income space. So for anyone who wants to pop on the website, that gives you a few ideas. But from a kind of region perspective, we've just come through the big European period. So in Q2, Europe paid over half the income despite not being over half the index weight. So we saw Scandinavia, Norway, Sweden, then rotated into mainland Europe through kind of Germany, Italy, France. So we've seen that country rotation. On the kind of sector side, we saw some really interesting opportunities in financials. So European financials were great from a return and a yield perspective. And then one of the other themes has been within IT, obviously, is the hyperscalers, AI, CapEx concerns, but we've seen that rotation from software that was leading markets to semiconductors and that kind of nuts and bolts hardware type stocks. So we've seen a bit of an underweight software, overweight semiconductors in the strategy as well. There's some of the key themes where we've seen not just yields, but also on the return side.
Okay. Now, you previously mentioned the 150 red flags, but with ongoing market volatility, the inflation concerns, geopolitical uncertainty, how do you manage risk within the fund?
Yeah, there's certainly a lot going on. As you know, risk management is critical. I think a lot of managers just focus on the return side, and you can burn your returns pretty easily if you don't look at the risk. So within the strategy, we have quite benchmark aware to MSCI. So we have constraints on sectors, countries, stocks, even on styles. But three key ways, and I'll keep them pretty succinct for this, but three key ways we like to say we win by not losing. We have a dividend trap model, so a model that forecasts the risk to income that protects the yield. We have the red flags that we've just mentioned, which kind of protects investor capital on the return side. And then the third way is stress tests, which we run over the top of the whole strategy. And so that can be, we got about 110 we run daily. That can be anything from the impact of a 30% change in a commodity price like gold or oil or a currency. It could be we scrape the predicted markets, poly markets, and we take the probability the Strait of Hormuz will close, and we use that to proxy the risk in the fund at the stock level. So I think those three ways, Joel, are dividend trap model, protect yields, the red flags to protect investor capital, and then stress tests to try and avoid those macro exogenous shocks that can hit a fund manager from left field when obviously you least expect it.
Okay, so for Australian investors who already own local shares, what benefits can global income provide to their overall portfolio?
I think if I had to sum it up in one word, it'd be diversification. I think that most clients we speak to, and obviously a lot of them, we've got a really strong Aussie income business as well that Don and Pete have run for 15 years. A lot of people agree diversification is kind of a free lunch in finance, and there's not many. But for a retiree who's held stocks PA, and often like the miners, the banks, Woolworths, it's a really hard conversation to say, we want you to diversify. And when you're talking to your clients, but we're going to take that 6, 7, 8% yield and we're going to blend it with global at 1.5 in a passive fund, and you lose all your income. So with this strategy, we're delivering 6% high yield and also growth, which at the end of the day, you need to combat that longevity risk. That worry that retirees could outlive their money, you need a bit of growth in there. And you know, global markets have done 20% plus per annum over the last 3 years. So I think that diversification, an Aussie investor, 7 stocks and really 1 industry, banks, pay over 50% of the domestic income. It's really concentrated, and if you diversified in our Aussie fund, you've got diversification, but you want sectors, countries, styles, stocks that you don't have access to here. You really need to look global to diversify, not just your return, but your income as well.
Yeah, so you spoke about the Euro sector doing well, or the Euro region, and then talked about tech and semiconductor sectors, but are there any other particular sectors that you're positive on at the moment?
Yeah, I think just a bit of a caveat is that we're very diversified. So we're very risk control. We don't take kind of big bets, but as you'd imagine, there's some definite thematics that show through. We try and put in the fund the best of quality, of value, of growth. And I'll give one quick example in each just to show some of the themes that we're looking at. If you think value, it's actually the one we just mentioned, Joel. Like, so Europe, especially financials, a lot of those European financials trading at a low PE compared to a CBA, but delivering high yield and also high return. If we then flick to growth, we've rotated out of names like a Palantir and AppLovin that were hit with a bit of that SaaSpocalypse drawdown we saw earlier on, and looking a bit more in those names like Micron or Lam Research that are in the semiconductor, the nuts and bolts space as a way to play that AI trend. And then within quality, I'd probably look at aerospace and defense and industrials. So with Ukraine, with the Middle East, with the kind of global defense spending, we've seen the increases. It's been a real boom for aerospace and defense stocks. So as an Englishman, you often think quality of Rolls-Royce, you think cars, but huge commercial and military kind of engine business. And so I think there's some of the key thematics we've seen that we've been positive on for a little while, but there's been, like the tech one, there's been rotation in what's been the driver. That's always moving.
Okay. Well, what are some of the biggest misconceptions investors may have about global dividend investing?
Yeah, these are the things we have to try and rally against and explain. But the key one for me has always been there's no income in global. Um, we touched on it earlier, and you, Joel, would know this with all your clients, that at the end of the day, retirees have had a great place domestically to invest, high yield, franking credits, and they look at global equity, the market paying less than 2%, and just say, look, there's no yield. I get it, but hopefully we've dispelled it to a point. As I said, we've been paying 6% for over 10 years now, 6% per annum, and we've paid it monthly as well, which people love. So I think just a couple of stats that the opportunity set in global's huge. In the worst month, there's 400 stocks on average pay a dividend. In the best month, there's nearly 2,000. But within my universe of kind of stocks I can buy, over 1,000 names pay 4%, and nearly 400 of them pay 6%. So there's twice as many stocks paying high yield over 6 than there is in the ASX 200. So
Right.
there's definitely a lot of opportunity, but you really do need to know where to find it globally, because there is a huge opportunity set. And as you can imagine, they're not all great investments.
Well, you spoke about the opportunities, but what would you say would be the challenges you see in the global equity income space over the next couple of years?
Yeah, we're positive, conservatively optimistic. Is that the right way to say it? The yield's been great. If we're looking income specific, developed markets, the last quarter was nearly 6% growth on previous. The last few years coming out of COVID, which was challenging, there's been really strong div growth, but markets have run, so yields have softened a bit. The denominator of yield has kind of run more than the numerator. The dividend cut model I talked about earlier, we take the risk to every dividend globally. We aggregate them all together, and that gives our view of markets, our forecast of this question. So what's the challenge to income? And it's actually at a level slightly below the long-term average, which is fantastic news for retirees. We think that over the next couple of years, there's a low risk of corporates cutting dividends, but there's definite pockets. If you think tariffs, we've seen recent changes again. What's been going on in the Middle East, the Ukraine, that's really challenged shipping and logistics businesses. So if you think SITC, AP Moller Maersk, inflation, interest rates has challenged the consumer, cost of living. Some of those luxury goods, consumer discretionary businesses, we see some risk there. So overall, a great picture. We think the risk to yield is low, but I think it really reinforces the importance of active management. You've got to know where those pockets of risk are and sidestep them. And COVID was a great example. We use those dividend traps to avoid Henze Moritz, Deutsche Bank, some of those names that cut to zero. And that was how, even in a really tough period for income, that process we used to generate yield maintained a pretty consistent yield outlook.
Now, Dan, we've covered a lot of ground in this session today. Is there anything else you'd like to share with investors before we let you go?
No, I think that the main things, a thank you. Hopefully, for those who've invested, it's great to have support. For those who haven't, hopefully this has piqued your interest, and we'd love to help any investor on their retirement and investment journey. The only other thing to mention as well is that we launched an ETF, PGI2, Plato Global Income 2. We launched that in May, and that is just another way to access this fund. It's the same pot of money, but just a listed option, and that's had a fantastic reception. So it's grown to over $100 million in 2 months, which is great. So for those who are interested, we'd love to speak to people further, and hopefully this has given you a little bit of insight in how you can have a global allocation, but also your retirees that need their income to fund their lifestyle can get that diversification.
Perfect. Well, Dan, I appreciate you making the time today.
It's a pleasure, Joel. Great to speak to you.
If you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out to me via our website or give our office a call to schedule an appointment. I appreciate you making the time to speak with us, Dan, and it was great to hear more about Plato and how you generate income from investment portfolios.